Private credit, I think, for a lot of people just sounds complex and complicated. Let's remind it, what are we talking about exactly?
Yeah, at its core, it's really the lending function broken down into a direct relationship between the lender/investor and the borrower. So you have a bilateral negotiated deal that each party agrees to and gets into. And the reason why we think it makes a lot of sense is you have the time to do your underwriting and put in place a set of loan agreements and terms that you feel comfortable with.
What proportion of this debt is floating rate?
Most of it. I would wager to guess close to 90%, if not more.
Which would be great for the investors if floating rate, if we're going from 6 to 8% or something. And I know in some cases we're talking about 12%. But now I wonder this week especially if rates are getting so high that we're starting to see investors flip and worry about defaults. And we used Petco as one example, obviously, of a company whose debt servicing costs are crowding out their earnings almost completely. How much of a default problem could the industry be facing if yields stay where they are for a lot of these companies?
Yeah, it's a great question and one that we're focused on. Ultimately, it will depend upon where the economy goes. But if you think about it, most of private credit lending is at the top of the balance sheet. So the most secure part in the capital structure of these companies. Most often you have other institutional investors alongside you, equity, subordinated debt, etc. So you tend to be in a spot where incentives are aligned and everyone wants to work to a good outcome. That being said, the closest proxy to a default cycle is tracking middle market loan data going back 15 years. And what we've observed is that when you look at that data, it has actually tended to perform better than broadly syndicated and public credit. And so that's a function for few factors, but that's what the data suggests.
Although the industry is also so new, forget private credit. I mean, very few people in the public markets or in the business, broadly speaking, have been through a high rate environment in their careers. And now this entire industry is about to be tested by an experience that it's never been through before. I mean, did this industry even exist about a decade ago?
Not in the form that it is today. You're right. It was sort of a niche industry. It has scaled. It has garnered investor appetite and allocation. And that's generally a good thing because you want more sources of capital at the table. Lending's occurred, of course, always in the private markets, but not in the scaled way that we're seeing today.
And so what do you think the next kind of 6 to 12 months look like? As you said, so much depends on the economy. And if companies start to run into trouble, do they, if you were a bank extending these loans, I guess at some point they could come to the bank or the loan officer and try to work that out. What happens in this case? How does that adjustment work if an adjustment needs to be made?
Yeah, I think you'll find 99% of the time that people tend to be rational about what needs to get done, right? There's a few options you can go down. Usually proactive management is the way you do it by raising incremental capital, be it equity, structured equity, some kind of structured solution, and there's a large and growing market for that as well. Asset sales, cost mitigation, we're focused on it. On the front foot, investing into this environment is good, but we have portfolios to manage, and that's topic number one for all our portfolio companies.
Where do you feel most comfortable still extending credit?
In the most defensive sectors, and that's been a core philosophy of ours, high free cash flow generation, and typically asset-light industries because they don't chew up capital. So you have a tremendous amount of operating earnings to cash flow conversion, and that'll remain the case because it gives you a buffer when things go sideways, and that's what we always underwrite to as well.
Does that mean technology asset light, or is technology a big part of this?
Yeah,
software companies,
software, long, predictable contracts, throw off a lot of free cash flow, business services, insurance brokerages. Those are typically assets and companies where there has been a good amount of private credit capital formation. So that would lead you to believe that the default outcomes would also be reasonably robust.
Better. Absolutely. Well, we really appreciate you, Ashwin, coming in and talk to us about it today. An interesting juncture, I would say, for this whole industry. Appreciate your time. Thank you.
Thank you, Kelly.
Ashwin Krishnan joining us from Morgan Stanley.